It has been a tough year for startups looking to raise money. Investors are getting pickier. Funding for early stage startups is declining. It fell by about half in the second quarter of the year compared to just about a year ago. That's according to the latest numbers from Pitchbook. Here for a little bit more analysis, we want to bring in Kyle Stanford, lead VC analyst at Pitchbook. Kyle, it's good to see you. So just paint a broad picture for us just about what the current VC landscape looks like right now. The fact that so many venture capitalists are pulling back on their funding, what position that leaves the startups in?
Yeah, really, the startups are in a difficult position, right? I think when we talk about what's going on in the market, there's 51,000 private VC-backed companies right now. And then there's also, like you said, maybe about half as much capital. And so these companies are trying to find a way to move forward. There's a lot of sectors that are very concentrated with multiple, growing, fast-growing companies. So it's really difficult to, pick and choose the best in each one. And at the top of the market, like even though, ARM and Instacart and some of these companies are talking about IPOs, there's a huge backlog. And so there's companies that are trying to fight and try to become efficient with their capital and make sure they're not going back to the equity markets if they don't need to. And investors, again, are still being smart with their money and trying to be efficient as well.
So where is the money going where there is money being delivered? Is this, is this the fintech? Is this just, a pure tech play who has AI in its name, for instance? Kyle, where is the money actually going?
Right. AI has been the narrative of the market this year. And so there has been, some very large companies that are raising large deals, but I think this downturn has been spread across really all the sectors. When we talk about comparing to 2021, where every sector was raising record amounts of capital and record amounts of deals were getting done, every market, even AI, is still at a much slower pace in 2023. And so, strong companies in any market, whether that be pharma and biotech or climate tech, those companies are being able to find capital. It's the companies that are struggling for growth or struggling to hit the next benchmark in their category that are having trouble, and that is kind of going across the board today.
So, Kyle, is that accelerating a wave of closures, and what does that closure rate look like?
So we actually haven't seen a rate of closures really increasing in the data. We have seen an increase in down rounds. Our last valuations report, about 15.2% of completed deals in Q2 were at a lower valuation than the company's previous round. And that's much significantly higher than what we saw a couple of years ago. I think the low quarter we had was only 5% of deals closed. So, what we've looked at is there's actually so much capital going into the market in 2021. The companies have been able to find ways to continue lengthen their runway, whether through layoffs. Obviously, were a huge story the past year. Debt was very high in 2022. So these companies have actually been able to continue operations. So we haven't seen the large wave of closures yet. But as these down rounds pick up, that will filter into also companies that aren't able to raise. And so if we talk about when to think about closures, if nothing changes in the exit market, we would expect some closures probably now and toward the end of this year. We do expect a lot of kind of startup to startup M&A to kind of consolidate in some of these markets, and that's not always it's not a closure, but it's not necessarily the exit that many investors were hoping for.
And Kyle, when you say that only 5% of those deals closed, what was in those, or what was unique about those deals that got them across the finish line?
Yeah, so I think right now, as companies are able to show path to profitability, that's what investors are looking for. And so companies that are able to raise are very strong in revenue growth. They're very strong in path to profitability. And the 5% you mentioned, I think I was talking about down rounds. Those are just like probably some companies that were really struggling to raise, but they were still finding some equity interest in the market in 2021. Now at 15.2%, down rounds are increasing. It's much more common. We do expect that number to tick up in Q3 and in Q4 until really the public market starts to let this capital cycle through the venture market.
So Kyle, what do you make of the success when it comes to Skims? And I bring this up because just, several weeks ago, they raised another $270 million in funding at a time when so many VCs are shying away from these direct-to-consumer brands. What is it about Skims' business model, or is it simply its affiliation with Kim Kardashian that's making it so successful at a very difficult time for startups?
Sure. I don't want to give one person too much credit, but obviously Kim Kardashian has done a great job with that brand and is very, very prominent in all markets, whether it be in direct-to-consumer in Skims or in reality TV. Everyone knows who Kim Kardashian is, right? But what that company has done is really built its brand on its main thesis, and it's really driven home to the potential customers of the what a great product it is, and it's they've found a need in the market and really have helped fill that. So obviously Kim Kardashian has been a major boost to that company, but it's a great product and it's really found a need in the market.
Now worth $4 billion. Pretty incredible there. All right, Kyle Stanford, great to get your insight. Thanks so much.
Always, thank you.